Senator Cassidy.
Gentlemen, just enjoyed your testimony, all of you. A couple things just for the record. In terms of selling Strategic Petroleum Reserve, one of you mentioned that we've already sold off a portion of it. We haven't sold it yet. Ed Markey and I have an amendment that allows the government to time the market, to sell it high and replenish back low. And so theoretically, I think it's 2023 that they currently plan to sell, but they can move it up now to take advantage of high market prices and kind of, if you will, win-win. A win for the taxpayer, but also to get the higher price now to do the repairs to the infrastructure that Madam Chair was able to put in. Secondly, I also want to point out that Senator Cantwell asked, what has the Tax Cut and Jobs Act bill done for this? I've been told to people, I've been told by folks that companies have accelerated their pipeline construction that was planned for the early 20s into these current years because of the 5-year depreciation. And so they're taking advantage of the Tax Cut and Jobs Act bill to just to move these projects now. And so midstream is responding to our tax bill, so that would be one answer to Senator Cantwell's problem. The other thing I want to point out is the delay that occurred in the last administration on the construction of the Keystone XL pipeline has definitely created a supply constraint. My Gulf Coast refineries use that oil from the Canadian tar sands and from the Bakken. And the last administration put in constraints, and now we're complaining about no higher gas prices when it was the previous administration's policy which has contributed to that. I also wish to point that out, and we would not be talking about midstream constraint had there not been some of the strategies of the previous presidential administration. So all that said, I've used up 2 minutes. Let me just explore something. I will note that when the prices fell, part of the reason they fell is that overextended shale producers had hedged future production. They continued to produce even though prices were $30 because they had hedged to sell at, say, 60, and that kind of drove prices down. We've now shaken out the production market, knowing that you know this, but just for context, we've shaken it out so the more efficient, those who have the cash cushion to get through the low price period survived. But in a sense, shale will respond as a swing producer because now that prices are up, more fields will be developed. Inevitably, there'll be some who, again, hedge, but they will bring out, so somebody mentioned, or I've read in my state, Austin Chalk, which is coming online and is going to be, at least in the near term and intermediate, a new source of production, which probably will maybe overproduce a little bit. Any comments on the role of things like Austin Chalk and the OCS and these other fields coming online to at least in the intermediate, maybe 6 months from now, making some impact upon these high prices? Yes, sir.
Well, Austin Chalk certainly will. And the reason why Austin Chalk works is exactly the reason that you said, is because the economics support drilling in Austin Chalk and support drilling in Eagle Ford and Permian and all the other basins that I mentioned a few minutes ago too. So what is happening in the market is in fact giving us the response that we would expect. Now, shale in the United States is not going to be a swing supplier getting to your 4 weeks, whichever one of you guys said. Correct. 4 weeks has got to hit. That Austin Chalk's not going to happen in 4 weeks.
But we really can't expect relief after, say, Labor Day, because not only will summer driving season be over, but the Russians going into winter, I understand, have to keep full production or else they freeze in. And then some of these things like Austin Chalk will be perhaps hitting their stride. Is that a fair statement that we can expect after Labor Day some relief from this?
That's a fair statement. And one of the things that hasn't been mentioned in this hearing so far is the forward price of crude oil at West Texas Intermediate and in Cushing, Oklahoma. That's the price that we've been talking about here for the most part. That price in 5 years, in 2023, is $55. So going back to Senator Cantwell's question a few minutes ago of what's the price premium in the market for all these various uncertainties that we're seeing right now in the marketplace, I could make an argument that all of the uncertainties added up are a $15 premium, because if somebody wants to sell or buy crude oil right now in 2023, they'll do it at 15 bucks. Keep in mind then, back to your decision that you've got to make about when you want to do something with the SPR. I tend to think the SPR ought to be saved for some real crisis.
Well, we've already made the commitment to sell it. It's just not been sold if the Markey Amendment and the Cassidy Amendment has been adhered to.
My only point would be the price right now is $70. The price in 2023 is $55 on the futures market.
Sell it now.
I was a trader for 15 years of my career. I'd sell now.
And you mentioned, Mr. McNally, that we're going to always be in boom and bust. On the other hand, plausibly, we can say that with the Keystone XL pipeline being built, the intermediate being built from the Permian and elsewhere, the midstream, and then I'm told by the super majors that they're going back out into the outer continental shelf, that we're going to have significant production supply over the next 1 to 4 years, and which may account for the $55 a barrel, but we may see some leveling off. Is that a fair statement?
Certainly, Senator Cassidy, that is a fair statement. I believe the IEA and others believe that the United States is going to be half or more of non-OPEC supply growth. So we took the lion's share since 2009, and we're going to take the lion's share as we build out this midstream infrastructure and connect it. Again, as long as we remain open to production and permitting, we can expect that to expand. But if I may, on the SPR, I was never a trader. I worked for a hedge fund for 12 years, but I never traded. But I am a student of history. In 1996, Congress and President Clinton last sold SPR crude for budget expenses in 97. At that time, oil prices were on the high end of the range. They thought they were selling high, about $26 a barrel. I was in the White House and the National Security Council after 9/11 and oversaw the refilling of the SPR at much higher prices. So I'll predict, and I predicted before, I'm afraid, sir, that we may think we're selling high, but I predict we will put those barrels back in. We may have to buy them from the Chinese at higher prices after the next Gulf emergency. So I agree with Mr. Brazil. I think, not on the selling now, I think we should hold it for an emergency with respect.
Well, again, that decision to sell has already been made. It's just a question of timing the market.
Right.
I have more questions, but I'm way over time, and I yield back.